TSS and BTE have joined forces.
Context,
Power.
edge.
The new paradigm of trading.
We usually operate under this really comforting assumption that the stock market is just a rational reflection of the real world.
Right, yeah. Like it actually makes sense.
Exactly. Like a company announces a breakthrough product and its value goes up. Or, supply chains freeze, the value goes down. We expect this fundamental human logic to kind of steer the ship.
We really want to believe that, yeah. That human beings making fundamental judgments about the economy are the ones dictating where the capital flows.
But that's not really true anymore, is it?
No, not at all.
Oh.
I mean, the reality is that modern financial architecture has almost entirely detached from that kind of human logic. It's wild.
Which is exactly why we're digging into this today. So if you're joining us, you are a learner. You're someone who wants to skip the surface level noise of financial television and understand the actual mechanical forces moving the global economy.
Mm-hmm.
So today's mission for this deep dive is pulling up the floorboards of Wall Street. We have a stack of highly technical institutional notes from Spot Gamma.
Yeah, really dense stuff.
Very dense. Specifically, we've got their daily market updates from late June 2026, a historical note from April 2026, and this critical market alert about sector rotation.
Right.
And we are going to show you how algorithmic options trading, dealer hedging, and the structural force called gamma actually engineered the violent tech sell-offs and multi-billion-dollar sector rotations we saw in June 2026.
Yeah, it was a massive shift. And to contextualize those late June sell-offs, we really need to look at the baseline expectations just days prior.
What were people expecting?
Well, the institutional base case heading into those final weeks of June was incredibly mild. They projected, a standard 1% to 2% correction.
Oh, so nothing crazy.
Right, nothing crazy. The entire financial ecosystem was seemingly just holding its breath, staring at this specific S&P 500 level of 7,475.
7,475.
Yeah, they labeled this the risk pivot.
Because the market was basically functionally paralyzed waiting for the June 25th core PCE inflation data, right?
Exactly. Everyone assumed that inflation print would be the catalyst for the next big move.
Right. So looking at June 22nd, the S&P 500 traded within this suffocatingly tight 94 basis point range.
Yeah, really tight.
And it ultimately closed just a hair below that 7,475 risk pivot. It closed at 7,473.
Which looks like textbook market hesitation.
Yeah, on the surface. But under the surface, the options order books were flashing these massive structural warnings. Like the data shows this absolute frenzy of call buying concentrated almost entirely in AI-related equities.
The volume was staggering. I mean, it created a severe distortion in this metric called KOSPI.
KOSPI.
Yeah, KOSPI. It measures implied correlation across the options market. And when you see KOSPI spike all the way up to 8, as it did here,
Wow, 8 is high.
it's massively high. It indicates that traders aren't just betting on individual AI companies anymore. They are treating the entire tech sector as a single monolithic momentum trade.
Like one giant bet.
Exactly. And the notes explicitly warn that this concentrated, highly correlated leverage created the exact conditions for a volatility spasm.
A spasm. I love that term. Let's break down the mechanics of why that spasm actually happens, though, because it revolves around the market makers, right?
The institutions on the other side.
Right, the ones sitting on the other side of all those AI call options. Because if I'm a major fund and I buy a massive block of call options, betting that AI stocks will surge.
The market maker who sells you those options is suddenly totally exposed.
Exactly. If the stocks skyrocket, they stand to lose billions.
Yeah, they don't want that risk.
So to neutralize their risk, they immediately go out and buy the underlying shares of those exact AI companies.
Right. They are managing what is known as delta.
Delta.
Yeah. When they buy the underlying stock to hedge the call options they just sold to you, they're creating positive delta.
Got it.
And their own mechanical hedging actually drives the price of the stock higher.
Which encourages more traders to buy more calls.
Exactly, which then forces the market makers to buy even more stock. It becomes this self-fulfilling upward spiral.
It's like a rubber band, right? It just gets stretched to its absolute physical limit.
That is a perfect analogy, yeah.
But then, on the morning of June 22nd, the momentum shifted. At 10:00 a.m. Eastern, traders finally started cashing in those winning lottery tickets.
They took their profits.
Yeah, they sold their calls to take profits. And that Kiwana metric we talked about, It suddenly plummeted from 8 down to 6.55.
A huge drop.
Massive. And in the next 40 minutes, the S&P 500 dropped 92 basis points. I mean, almost a full % of the broader market vanished in less than an hour.
And here is the crazy part. The catalyst wasn't an economic data release or like a geopolitical shock.
Right, there was no real-world news.
None. It was just the mechanical unwinding of those dealer hedges. When the traders sold their calls to take profits, the market makers were suddenly holding these massive stockpiles of AI stock that they just didn't need for hedging purposes anymore.
Because the risk was gone.
Exactly. So to return to a neutral posture, the algorithms automatically dumped those shares right onto the open market.
Wow. So the underlying fundamentals of those AI companies hadn't changed by a single cent at 10 a.m.
Not at all. The violent price drop was purely the result of algorithms generating massive negative delta to rebalance their books.
But that unwinding process, it didn't just cause a 40-minute blip. I mean, it completely fractured the structural stability of the market.
It really did.
If June 22nd was the tremor that compromised the foundation, June 23rd was the ensuing avalanche.
Yeah, the macro numbers from the 23rd are just brutal.
Brutal is the right word. The S&P 500 fell 1.4%, the Nasdaq dropped 3.3%, and the semiconductor sector tracked by that SMH ETF was absolutely decimated. It fell 7.0% in a single session.
And the global markets caught the contagion, too. I mean, South Korea's KOSPI index plunged 10% overnight.
10%, just incredible.
And the internal data reveals the true scale of this mechanical selling. S&P 500 equities printed a staggering negative $4.8 billion in delta flow.
Negative $4.8 billion.
Yeah, that was the most negative reading the market had seen in 30 days. And it was heavily driven by institutional players liquidating longer-dated call options. The structural support holding the market up just simply evaporated.
To really understand why the floor fell out so aggressively, we should look at that historical note from April 23, 2026. It offers a pretty perfect parallel.
SPA-Gamma pulled that April data specifically to highlight how these structural failures repeat themselves.
Right, because back in April, the trigger was completely different. Brent crude oil spiked over $100 a barrel due to a geopolitical conflict.
Yeah, a totally different macro event.
But the underlying mechanical reaction was identical to what we saw on June 23rd. The S&P 500 tested a critical risk pivot, failed to hold it, and the entire options landscape just inverted.
Right, and the key indicator in both of those events is the trace gamma heat map.
The heat map, yeah, explain that real quick.
So this maps out the cumulative exposure of market makers across different price levels. In the April event, the zone between 7,050 and 7,100 violently shifted from purple, which indicates a positive gamma environment, to red, which signals a negative gamma environment.
Okay, wait, I need to push back on this traditional understanding of market makers here, because we're taught that these massive institutional dealers exist to provide liquidity and ensure an orderly market.
Right. They're supposed to be the good guys, basically.
Yeah, they are supposed to be the shock absorbers. But you're describing a scenario where the institutions themselves are the ones forcing the market to crash.
Yeah.
Are they really programmed to aggressively sell into a market that is already in freefall?
Yes, the math forces it. And honestly, it is the most dangerous phase of modern market structure.
How does that work?
Well, in a positive gamma environment, so when that trace heat map is, purple dealers actually do act as shock absorbers. If the market dips, their options Greeks shift in a way that requires them to buy stock to stay neutral.
Which supports the price.
Exactly. And if the market rallies, they sell, which cools things down. They buy weakness and sell strength.
So they operate like the brakes on a car going down a steep hill.
That's right. But when the market crosses that risk pivot and the heat map turns red, we enter negative gamma.
And the brakes fail.
Worse than fail. The entire mathematical paradigm flips. Because dealers are required by their risk departments to remain perfectly neutral, their hedging algorithms are now forced to operate directionally with the market.
Directionally with it, meaning they follow it down.
Yeah. As the index falls, their short put positions expose them to massive directional risk. To hedge against the falling market, their computers must instantly short the underlying stock.
Oh, man. So the faster the market falls, the more aggressively they are forced to short the market.
Yes.
Which in turn makes the market fall even faster. It's just a self-reinforcing cascade of selling pressure.
Exactly. And it doesn't matter if the companies in the S&P 500 are reporting record earnings or, sitting on mountains of cash.
The fundamentals don't matter at all.
None of it matters. The algorithms are just executing mathematical equations to save the dealers from going bankrupt. The selling is entirely unemotional and agnostic to value.
It's just pure structural delta flow pushing the broader indices down the stairs.
Pushing them right down the stairs, yeah.
Now, what's really wild is that while the macro index is suffering this systemic failure, the behavior of individual stocks becomes kind of fascinating.
Oh, absolutely.
When we zoom in from the S&P 500 down to specific equities, we see these bizarre micro-narratives playing out, like SpaceX, ticker SPCX is a perfect example of this.
Yeah, that was a crazy day for SpaceX.
On June 22nd, the stock dropped 17% to close at 155, and the notes map out the exact algorithmic triggers for this. SPCX rejected the 180 key gamma strike, slid right through the 177.5 hedge wall, and then experienced a violent 15-point bounce just above the 150 put wall. So my question is, if the broader market is in a mechanical freefall, how does an invisible options line at 150 suddenly stop the bleeding for a multi-billion-dollar space company?
Well, those walls are the physical manifestation of options concentration.
Okay.
A put wall simply represents the strike price where the highest volume of put options, bets that the stock will go down, are concentrated on the dealer's books.
Got it.
So as SpaceX's stock price plummeted toward 150, the market makers who sold all those puts were heavily shorting the underlying stock to hedge their exposure. That shorting accelerated the drop. But 150 is the inflection point.
Because the moment the stock actually hits 150, those options are fully in the money. Right. And the traders who bought them cash out to take their massive profit.
Exactly. And when the traders cash out, the market makers no longer hold the risk of those puts. Their hedging requirements instantly vanish.
Yep. Gone.
Gone. So they have to rapidly buy back all of that stock they were just shorting. You go from intense algorithmic selling pressure to massive concentrated buying pressure in the span of seconds.
Wow.
That forced buy to cover is what triggers that violent 15-point bounce.
So sophisticated institutional players are looking at a market that is just drowning in negative gamma. And instead of panicking, they are simply hunting for those specific structural floors.
Yeah, they know exactly what they're looking for.
They know exactly where the market makers are mathematically trapped, and they exploit the unwind. And we saw similar chaotic alpha hunting across the board, didn't we?
Oh, everywhere.
Yeah. On June 24th, Wendy's ticker WEN suddenly catches meme stock fever and surges 42% on retail inflows.
It's out of nowhere.
Out of nowhere. Then you have what Spot Gamma called the Flu Patrol winners. Take-Two Interactive's September 270 calls gained 100% in value over a month.
Yeah.
And most extreme of all, this quantum computing stock called Inflection saw its July 20 calls gain 100% in exactly 30 minutes as the underlying stock climbed 12%.
The divergence is wild, right? The S&P 500 is structurally broken, yet massive amounts of capital are finding incredibly targeted rapid alpha in video games and quantum computing.
It's like finding treasure in a burning building.
Yeah. It illustrates that capital doesn't just disappear in a negative gamma environment. It just frantically searches for pockets of positive gamma.
Which perfectly sets the stage for the final act of this June saga, spanning from the 24th to the 27th.
Right.
We get what looks like a miraculous rescue by the AI chip sector, but it's actually masking a massive institutional sleight of hand.
Yeah, the tension heading into the 24th was focused entirely on Micron's earnings. Micron, ticker MU.
Everyone was watching them.
Everyone. The auctions flow is almost completely dominated by 0DTE, trading 0 days to expiration contracts.
So options that expire on the exact same day they are purchased.
Exactly. They serve as pure, hyper-leveraged directional bets. And the market had priced in an implied 11% move for Micron based on the options premiums.
But Micron shattered those expectations. The stock rallied an actual 15%, breaking cleanly through what was identified as the 1200 call wall. And that massive upside move officially pushed Micron over the $1 trillion market cap threshold.
Which is huge news.
Huge. If you were just reading traditional financial news that week, the narrative was completely triumphant. Micron's trillion-dollar valuation had seemingly saved the tech sector and provided the fundamental justification for the whole AI boom.
That was the headline, yeah. But the internal delta flows tell a completely contradictory story.
They always do, don't they?
Always. The June 27th market rotation alert reveals what the institutional money was actually doing while the public was celebrating Micron.
Oh, this is the best part.
The alert details how the broader S&P 500 remained firmly stuck in a negative gamma regime, suffering from continuous algorithmic sell-offs. The Micron rally was just an isolated event.
It's the ultimate magician's misdirection. The market is waving this shiny trillion-dollar Micron milestone in your face with its right hand.
Let's go over here.
Right. Meanwhile, the left hand is executing a silent, aggressive rotation. Billions of dollars were being systematically pulled out of falling mega-cap tech giants and funneled directly into healthcare and defensive software.
Yeah, the note specifically referred to these new positions as options fortresses.
Options fortresses. But why wouldn't a fundamental catalyst as massive as Micron's earnings be enough to repair the broader tech sector's momentum?
Well, because fundamental catalysts cannot instantly overwrite structural mechanics.
This can't.
No. Micron's earnings were stellar, but the massive call walls and positive delta that previously supported the broader tech index had already been liquidated back on June 22nd and 23rd.
The rubber band had already snapped.
Exactly. The market makers were still trapped in a negative gamma posture across the majority of the S&P 500. Institutional portfolio managers, these guys managing hundreds of billions of dollars, they look at the trace heat map, see that it's still glowing red, and realize the algorithmic sell-off isn't over.
So the shock absorbers are still broken, regardless of how many chips Micron sells.
Precisely why they executed the rotation. The smart money wasn't going to fight a mechanical avalanche.
You can't win that fight.
You really can't. They abandoned the tech equities that were heavily exposed to forced dealer selling and built those options fortresses in defensive sectors like healthcare. They moved capital into areas where the options chains still possessed positive gamma.
Just ensuring their portfolios had structural support against the ongoing volatility.
Exactly.
You know, when you look at the entire sequence of events from late June 2026, it really fundamentally changes how you have to view market behavior.
It changes everything.
You can't rely on quarterly earnings reports or macroeconomic data to explain why a stock drops 7% in an hour. The underlying reality is governed by the hidden plumbing.
Yeah.
You have to understand how implied correlation forces massive directional bets. You have to map out the gamma walls to see where the market makers are mathematically forced to buy or sell.
I mean, think about it. A simple, logical decision by a few funds to take profits on their AI calls triggered a mechanical chain reaction.
It's wild.
It forced dealers to unwind hedges, which flipped the market into negative gamma, which triggered automated short selling, which ultimately forced institutions to execute a multi-billion-dollar sector rotation into healthcare.
All from taking a little profit.
Right. The catalyst was human, but the execution was entirely dictated by algorithmic balancing.
The market isn't a reflection of human sentiment anymore. It's just a complex mathematical equation constantly trying to solve for zero risk.
And that reality introduces a deeply unsettling secondary problem.
Uh-oh. What's that?
Well, if the mechanical unwinding of standard options hedges can override the fundamentals of a trillion-dollar tech sector, consider the implications of a true exogenous shock.
Okay.
We are operating in a landscape where human shock absorbers have been replaced by risk-neutral algorithms.
Wow. So if a genuine black swan event hits like a massive geopolitical disaster or some totally unforeseen economic collapse, the initial drop is going to flip the entire global market into deep negative gamma instantly.
Instantly. And the automated response to that drop will be for every dealer algorithm to aggressively short the market to maintain neutrality.
Just piling on the selling pressure.
Right. If human discretion is completely removed from the execution layer, and the machines are simply following the math of negative gamma, there's a very real possibility that the algorithms will just mechanically sell themselves to zero before anyone can even cut the power.
A completely rational equation resulting in total systemic failure. That is a really heavy concept to walk away with.
It definitely is.
Well, thank you for taking this journey with us into the actual mechanics of the market. We hope this deep dive arms you with a completely new lens to view the daily financial headlines. Keep looking for the structural walls, question the narrative of the ticker tape, and remember, just because the water is flowing doesn't mean you know who designed the plumbing. We will see you on the next deep dive.